I want to talk to you about financial statements. Financial statements are very important because it's the presentation of your company on paper. Now, when it's on paper, it can be compared to other companies. So when a bank or an investor or some other type of entity is wanting to do business with you, they are going to look at your financial statements and make that decision. To understand the financial statements, you really need to understand three of them: the balance sheet, the income statement, and the statement of cash flows. Each of these statements shows a different side of your company, and it's important to understand each side so you understand the whole picture. So the first side of the financial statements we're going to look at is the balance sheet. The balance sheet is your assets, liabilities, and equity at one moment in time. It's as of the day that you're looking at it. So the balance sheet has separations: assets, liabilities, and equity. First, we're going to look at the assets. Assets are what you have in cash at that moment in time, how much people owe you, what you own in title, like vehicles, buildings, land, that sort of thing, how many investments you have, and how much product you have available for sale. When you look at the liabilities and equity side of the balance sheet, you're going to find your short-term debt. That's how much you owe vendors and maybe how much you owe your salaried personnel, accrued payroll. Then there's a long-term liability section which defines how many loans you have for all of the assets that you have purchased. Then there's a section called equity, and it's a little hard to understand, but the basic meaning is how much you've put in is considered common stock, and another section of equity is called retained earnings. And this is how many earnings you have accumulated since the beginning of your business. So why is the balance sheet called the balance sheet? Well, the total assets are what you own, and the total liabilities and equity is how you were able to own those assets. So for example, if you take out a loan for a building, that's your liability, and when you bought the building, that's what you own title to. One of the other reasons it's called a balance sheet is because at the end of the day, all of your assets will equal all of your liabilities and equity. The balance sheet gives the user an understanding of your cash position, how much tangible property you own, how much people owe you, how much you owe other people, and how many earnings you have accumulated to that date. The balance sheet also is where the numbers come from to calculate liquidity ratios, debt to equity ratios, and some other ratios. So the next side of the business is the one that you're probably the most interested in. It's the one that shows a period of time that shows how many revenues you had, how many expenses you had, and what your net income for that time period was. The income statement sometimes is called the profit and loss statement. That is because at the very bottom, after all of the revenues and expenses, you find out if you had a profit or a loss. Many components on the income statement include your service lines of revenue. So if you have a construction and a distribution line, they will show up separate. You'll have a cost of goods sold line if you're doing any kind of inventory. You may have a cost of construction line. All of these types of costs are directly related to your service lines, and after you take the revenue and subtract those costs, you'll have the top number, the gross profit. After gross profit, you'll have all of your selling, general, and administrative expenses like an audit fee. An audit fee can't be directly related to a job, so it's considered an administration expense. But if you had somebody who had a timesheet and they worked directly on a job, they're going to show up in the costs of goods sold or costs of construction. So once you have your gross profit and you subtract your selling, general, and administrative expenses, that will give you what's called EBITDA, because we haven't included interests, taxes, depreciation, or amortization in any of those expenses. So then there's this next section which is called other expense, and that is where you'll find your interest, your depreciation, amortization, and all of the other extraordinary income or expenses like COVID. After this section, you then have something called the provision for income taxes. That is where the net income after subtracting interest, depreciation, amortization, and any other expenses that we just mentioned, we have to calculate what your tax is. So you take the net income, multiply it times your tax rate, and that becomes your income tax provision. Underneath that, you have your final number, your net income or net loss. Part of the reason knowing why you were profitable during the year is how much profit to pay to yourself, how much to reinvest into the company, and possibly how much bonuses to give to your employees. Companies may be interested in the income statement because it shows the earning potential of the company. So if you're looking to sell, they're going to be really interested in how much net income you can produce during a period of time. The income statement will also show how the company makes money. And what I mean by that is what service lines you do have, what your costs actually are, and what kind of administration expenses you have. You can be as detailed or not detailed with this information as you want. Many companies do go the detail way so that they can give more information about what's going on in their company. The ratios that are produced by this statement are things like gross profit, return on sales, and some other ratios. The final side of the financial statements is the cash flow statement. Sometimes this is the most difficult to read and understand because it doesn't traditionally flow directly out of your accounting software. So the cash flow statement is kind of a mix between the balance sheet and the income statement. And what I mean by that is at the very top of the cash flow, we start with net income, and that line comes directly from the income statement. However, the bottom two lines are the beginning cash from the prior year and the ending cash from the current year, which is on the balance sheet. So what we're trying to do, this is acting as a reconciliation between what happened in net income and what happened on the balance sheet, because the balance sheet may have had changes in it that were paid with cash that did not happen as an expense, or you may have had an inflow like through a loan. A loan is not revenue, so it shows up on the cash flow because you got more money, but it also shows up on the balance sheet. So that's what this statement is trying to do, is trying to reconcile all of that activity into one statement so you can see how the money was used or provided for during the year. There are three sections to the cash flow statement. One is the operating activity, one is the investing activity, and one is the financing activity. Inside of the operating activity, that's where you find net income, and that's also where you find some expenses that were considered non-cash. Let me take a moment to explain that right quick. You have expenses that happen inside of the income statement, like depreciation and amortization, that had to be calculated, but it was not actually paid in cash. So what we do is we add those back to net income. So if net income was $100,000 and depreciation was $20,000, you really got cash of $120,000 because the depreciation cost didn't actually happen. So after all of these expenses are considered, then we start looking at changes in what happened to the balance sheet. What I mean by that, you may have had an accounts receivable in the prior year of $10,000, and this year you have accounts receivable of $0. That means during the year you received $10,000 in cash that was not accounted for in revenue, because when the accounts receivable was booked in the prior year, that's when the revenue occurred. So we have to add that back. Any change from the current year balance sheet and the prior year balance sheet, that's where we find that information in this section of the operating activities. Most of the accounts that are going in here are considered current. And what I mean by current is an accounts receivable is current because you're going to receive it soon. An item like a fixed asset, something you own like a vehicle, is considered non-current because it's not going to come off anytime soon. Inside of the investing activities, that's where you find how much you have invested into the company. And what I mean by investment is not stocks or loans. I'm talking about you bought a building. And so if you buy a building for $1 million, that's where it shows up on this statement. If you sell the building for the $1 million, that's where the proceeds from that sale will show up. Another item you can find in the financing section is when the company issues stock. This is when people pay you for ownership of the company. Now, in a small business, it's probably a capital infusion where the owner has money after getting paid profit and is putting that money back into the entity and not expecting it to be repaid. However, there do come times when you find a dividend is paid out to the people who own the company, and a dividend shows up in this section as well. Now, when you have all three of these sections filled out, you're going to come down to one number, and that's going to be called the change in cash. This number will be a summation of the operating activities, the investing activities, and the financing activities. And when you add this final number to the prior year cash, you're going to get the total amount of cash you had at the end of the year. So the reason the cash flow statement is called the cash flow statement is because it shows you where the cash came from and where the cash went. Now, in those sections I mentioned, the most important one is the net cash provided by operating activities. That number is going to tell you if management has the skills available to appropriately manage cash at the company. If you are looking at the operating activities of the company, just in that section, if that number is positive, management has good skill and good management over cash. If it's negative, you may want to look into why that is. So now that you understand all sides of these financial statements, you will have a clear picture of where your company stands, especially in comparison to other companies within the same industry.